afternoon, everyone. I'm Davina Manoharan, and these are my teammates Rita, Natasha, QC, Xiaoyi, Cindy, Leon, Edge, Cynthia, and Zhongli. Alright.
Ginger! Nelly!
Today we'll be talking about the 7 elements that make up financial planning. Cash flow planning, retirement planning, investment planning, insurance planning, income tax planning, education planning, and estate planning. However, for our presentation today, we'll be only talking about 4 out of these 7, which is insurance planning, cash flow planning, retirement planning, and investment planning. All these elements intercede with each other, which means that without one, another will be incomplete. Think of it as a dish that needs all sorts of spices and ingredients to make it complete, and without one or no, the whole dish would not taste as good as it's supposed to be. That's how all the elements of financial planning work.
Hi. Okay, I'm Suvita, and I will be talking about a little bit about retirement planning. So first off, I'll be talking about the definition. Now, the definition is in its name itself, retirement planning. So it's meant to be a plan that you have when you retire. So basically, it means a procedure or a process of of reaching certain criteria, and these criteria include income goals for your retirement. And not only that, it also includes commitments and your efforts that you have to have to achieve your income goals. And part of the commitments and effort all include finding income sources, evaluating your expenses, enforcing a savings program, and handling your assets. So a person, in order to evaluate their future cash flows, it all depends on how their income goal will be accomplished.
Okay, for my slides, there's a chart which you would see from your hard copy that, for example, we have 2 retirement plans in Malaysia. So the first one would be private retirement plan from the Citibank, and also, as generally we all know, EPF is also a Malaysian general worker must have kind of retirement plan. So EPF stands for Employee Provident Fund, based on Employee Provident Fund Act 1991. So based on this, the EPF on the source from Bernama newspaper in 2016, 6.7 million of the people, 65% until the age of 54, they would have less than 50,000 savings after they retired. So another 78% does not have basic amount of retirement money, which that means they need to continue to work until 60 years old. For this case, we have many types of retirement plan. For example, we have early retirement, traditional retirement, semi-retirement, and also the last one would be mini-retirement. So traditional retirement basically means that when you reach from 55 to 60 years old, you can retire at that age with sufficient saving. That's the traditional retirement. And then we have mini-retirement. Mini-retirement refers to those frequent kind of retirement that you can work, but at the same time we retire to rest, absolute rest, and then you go back to work again. And then semi-retirement is the same thing as mini-retirement, but it differs from person to person, personal savings, and based on their company's benefits and government benefits. Then we have the early retirement, usually based on 30 years old to 50 years old. So it's when you have enough saving, you can just retire from that age. And then from that, we have a lot of benefits for retirement planning, so such as when your family needs funds during your absence, and also availing tax benefits, and also when you have emergency, that kind of needed fund for medical insurance and stuff like that. So that would be for retirement planning.
Hi, I'm Natasha. So I will explain briefly about investment planning. Basically, there's thousands of investment that we can do, but most commonly used are 4. The first one is cash, the The second one is equities, which is in simpler words is stocks and shares. The third one is bonds, and the last one is property. So I'll explain briefly about these investments that I have said. The first one is cash. Cash is considered to have the lowest risk investment planning, which is it's a liquefied, which means you have the amount of money in your hand which you can use and keep as example in piggy bank. You can put it in piggy bank, then you can use directly from that. The second one is bonds. Bond is basically it's a debt that you buy or purchase from the government. And it's quite risky, but quite risky than the cash. So the higher the interest, the lower the profit that you can gain from that. The third one is equities, which is stocks and shares. Stocks and shares you can purchase, you can buy from companies which are legal in the countries, and from there you may have the profit depending on the performance of the company. So the higher the profit, the more you get and the more you gain from the company. So the last one is property. Property has a long term of profit you can gain, because for an example, you purchase a land, so the land might be increased in value 10 years or more depending on the currency and property worldwide.
Hi, I'm Lian. I will explain how to make an investment planning. So there's assessing that you need to complete where you at, such like appropriate investment. That one you need to select your age, and then it will have a significant impact on your investment strategy. Let's say if you are in 20s, you can allocate more of your portfolio to more aggressive investment like growth-oriented and small cap companies, for example. And then if you are nearing retirement, you can allocate more of your portfolio to less aggressive investment like fixed income and large cap value of the companies. And then you can complete your current financial situation. It's such like you understand your current financial statement, so be aware of how much disposable income you have available to invest. Take a look at your budget and determine how much money is left over for investment following your monthly expenses, and after you have set aside an emergency for requirement of 3 months, and then you can do the investment plan, and then develop your risk profile. That one you need to set your information investment. What do you want to do with the money you make from your investment, or what do you want to retire day, and then what you want to buy, a nice house or a boat, some things like that. And then stabilizing your goals. Set your goals from your investments, like how soon do you want to reach your financial goals. That will determine the type of investment that you make. If you are interested in a building, slowly you will select investment that generate a slower return on investment over time. And then creating the plan. You need to decide on how you want to diversify, and then ensure the plan is in line with risk profile. Consult a financial advisor. And then the last one, evaluate the progress. You should monitoring your investment from time to time.
Alright, good evening ladies and gentlemen. My name is Yi Chen Cheng, better known as QC, and today I will be presenting about the insurance planning part. So what is insurance planning? Well, first, before we go into insurance planning, I'd like you to know what actually is insurance. Insurance is, in short, a financial document or a contract that protects you from certain losses. Depending on what insurance you will get a certain amount of money back from the insurance company after they do some investigation when you have met with certain disastrous events in your life, or what you can say risk. Now, after that, let's see what exactly is insurance planning. Now, I've already said before that insurance is about protecting you from risk. So in life, risk happens all the time. And insurance planning specifically is to predict what kind of risk will happen in your life depending on your lifestyle, your marital status, everything you own. That can change all kinds of things on what insurance that you are supposed to get. So insurance planning in short is about calculating what kind of risk you will face in your current life and determine what type of insurance you want to cover those risks in. And because as life changes, a lot of the things in your life will change as well, and the type of insurance you want to get will change as well.
Hi, there are 4 more commonly known types of insurance, and the first one would be health insurance, which is also one of the most important type to have, because 4 more commonly known type of insurance, and the first one would be health insurance, which is also one of the most important kind to have. Reason being, if you get sick, or in worst case, if you get into an accident and you need to be treated in the hospital but are not insured, you're going to chalk up a hefty bill to the hospital, and nobody wants that. Okay, and the second one would be life insurance. Now, of course, this would be more important to people who are married or have children, because it can meet several of their personal financial needs, such as paying off their remaining debts after they're dead, or even just paying for their children's education needs. Now, it's not to say that single people don't benefit from this insurance, because they actually do, in the sense that once they're dead, this insurance helps to cover their burial costs as well. Now, most of the time, of course, it depends on how healthy and young you are, because the more healthy and young you are, the more confident your insurance agent will be to give you like a lower cost in insurance. The next type of insurance would be property insurance. This is when you have a house and then all of your assets, such as your furniture, would have to be insured, because they can actually come together to cover up a cost, and in the event that there's any case of burglary, or if your house catches on fire, at least this insurance will be there to cover like the lost cost of your assets. The last one would be auto insurance, and this insurance serves to cover any liability, and most of the time you would be needed to cover, and most of the time you would need to get the collision coverage to your policy. This is because if you get into an accident, these 2 policies are very different, on the grounds that the auto insurance covers any damages that happens to the other person's car, while the collision covers damage that happens to your own. But the most important note to take note of is that the policy also covers any bodily injury or death that happens to the other person if you are solely responsible for it.
So hi, my name is Cindy Kalista, and now I'm going to talk about cash flow planning. So first, what is a cash flow plan? Cash flow plans are strategic documents companies make in order to forecast its cash inflow, known as income, and cash outflow, which is known as outcome. So how does it work? The company X, let's assume that company X is a startup widget maker company, expecting to sell 4,000 widgets at $50 each. The company needs to pay cash expense of $50,000 a month and buy $75,000 a month worth of equipment in December. So, therefore, a basic cash flow plan is needed to ensure that it has enough cash on hand to meet these expenditures in the period in which they occur. Otherwise, it may fall short of its cash needs, or it will result that the company needs to decrease its outcome or increase its capital.
Hello, my name is Patry, and I'll be following up with Cindy. my topic is also cash flow, and I'll be talking about why is it so important. Well, it's important because cash flow, you need to know your income and outcome. So how do you do that is you need to measure your cash flow. Like company X, and they said. So let's say company X has widgets, they sell widgets. Okay, so you need to know your income, like your customer, people who buy the widgets from you, and your outcome. Your loans, you need to pay for your electricity bill, your workers, all those. So you need to measure them so you can get your cash flow correct. And all of this need to be specific. Like when is it coming in, when is money going out, how much is coming in and how much is going out. So all of this is to avoid lack of money. All this happens to a small business, lack of money, and yeah, so you need to watch out.
Hi, I'm Chong Ling. Next would be the conclusion. Well, there isn't much to mention anymore. For the first is you gotta fortify your future by having a financial plan. So basically, after retirement, you won't have any trouble with expenses because you're old. You can do much things. Your body can take the workload, the stress like it used to be. So just to prepare for yourself for whatever the cost you need for the retirement. And for the second one would be have your financial plan revised regularly. You gotta check whether if your things you're doing, if you're still on track, you gotta keep doing this, and to check yourself to see if that goal you can keep going through that lane, or you gotta change it because things might change during the ongoing course, and you gotta adapt to the situation. So this thing might be vary for each people. So just do whatever you do would be the best choice for the situation. And for the last one would be you gotta implement the plans you done. For the plans, for the things you have planned, you gotta do it in order to make it work for the results you desire to achieve of.
Thank you.